Good afternoon, everyone, and welcome to our Finance Focus webinar for business owners, where our panel of experts will be providing an update on recent and upcoming changes to help manage your personal finances and wealth, highlighting things to look out and prepare for. For those of you who don't know me, I'm Mike Dyer. I'm a business advisory and taxation partner with over 35 years of experience of dealing with and advising business owners across a range of sectors. And it's great to see that there are so many of you on the webinar today. For those of you who don't know Creston Reeves, we're here to help our clients with so much more than just accounting, business and wealth advice. We support you in achieving your ambitions so you can reach your brighter future, which is also why we host these webinars to help with any questions that you may have. So firstly, just in terms of a few housekeeping matters, this webinar is being recorded and a copy will be sent to you later today. We'll be asking you to take part in some polls throughout the presentations, and there'll be a pop-up survey at the end of the webinar as well. In terms of how to ask some questions, we've already had some come in through the system already, but please do continue to submit those if you refer to the screen in front of you, and I'll leave that there for a moment just while you familiarise yourself with the function. So over the next hour or so, we'll be covering the following areas: the inheritance tax changes announced at the budget last October, together with some tax planning opportunities, understanding the value of your business interests and the interaction with inheritance tax planning, the use of wills and trusts to help protect wealth, and making decisions with the help of cash flow forecasting. That will all be followed by a Q&A session when you'll have the opportunity to have your questions answered by our panel. So if I can now just introduce our panel on the screen. So we have Daniel Grange, who is a partner and head of tax, Joe White, who is one of our tax partners, Gemma Spencer, head of private client legal services, Tom Wacher, who's a partner in our forensic accounting and business valuations team, and Terry Burgum from Creston Reeves Financial Planning Services. So to set the scene for our webinar, the budget last October saw probably the biggest shake-up in inheritance tax rules since the tax was introduced in 1984. As well as the changes to reliefs and bringing pensions into inheritance tax that we'll hear about later, the Chancellor also announced that the tax-free threshold will remain frozen at £325,000 until April 2030, by which time it will have been at the same level for 21 years. So the impact of increasing asset values and the freezing of allowances mean that according to the revenues figures, inheritance tax receipts will increase from circa 8.3 billion in today's value to 13.9 billion by 2029-2030. So whilst inheritance tax planning has always been important, these changes and increases in asset values not being matched by an increase in allowances are going to make it even more relevant to even more individuals. Some of you will have known that there's been a huge amount of press coverage and protesting by farmers about the changes to agricultural property relief. However, there's been far less coverage about the changes to business property relief. And according to HMRC, the impact of the changes to these reliefs will raise just £520 million per year. And it will be business property relief that we'll be focusing on today. So to cover the inheritance tax changes, I'd just like to welcome Daniel Grange onto the screen and ask him to talk through those changes.
Thank you, Mike, and good afternoon, everyone. I'm going to start by covering the timeline of the inheritance tax changes that are coming in over the next couple of years. Whilst I'll talk briefly about the changes to agricultural property relief that Mike's already mentioned and the changes to pensions, the focus of this afternoon is on the changes to business property relief, which could affect all of you with trading business interests. So that's whether you own shares in trading companies, you're a partner in a trading partnership, or you operate as a sole trader. So what are the rules today and what do we expect to change over the next few years? I think it's really important to highlight that no changes to inheritance tax have yet come into force. As we stand today, there's up to 100% unlimited business property relief, or BPR, and agricultural property relief, APR, on qualifying assets. And the vast majority of pension funds are outside the scope of inheritance tax. These changes are due to come into force on the 6th of April 2026, so we have 290 days from today until any changes are effective. We've had the consultation document on the proposed changes, but we don't yet have draft legislation, so things could change before the rules are implemented. What I'm going to talk you through is based on the guidance and the consultation document that's been issued so far. Before I start talking about the changes, though, I think it's worth a brief reminder of the types of assets that qualify for BPR, so you can think about the changes to the rules and how those might affect you. BPR is available on trading businesses, whether those are sole traders, partnerships, or shares in unquoted trading companies. And unquoted trading companies include enterprise investment scheme qualifying companies and AIM listed trading companies. And as we stand today, there's 100% unlimited relief available on those assets. Whilst BPR is available on partnerships and sole traders, our focus today will be on private company shareholdings for our owner managed business clients. If you own shares that are fully listed, these will not qualify for relief, even though most of them will be trading companies, so it's unquoted trading company shares. To be a trading company, the business must be wholly or mainly trading, and that's a 50% test. So is it more than 50% trading? Looking at all factors in the round, including turnover, profitability, the value of assets that are used in different activities, and management time. And non-trading activities include things like holding investment property or investments. So BPR is not available on property investment companies or buy-to-let portfolios, for example. If you have significant non-trading assets, for example, investment properties, an investment portfolio, or perhaps surplus cash from trading activities within your business, this could prevent or limit the amount of BPR that's available. So before we move on, I think it's worth noting there have not been any significant changes to the qualifying conditions for APR and BPR, but it's the rates of relief that are changing. So from April 2026, 100% BPR and APR will be capped at £1 million per individual. So married couples can have up to £2 million of qualifying assets between them. But based on the current guidance and the consultation document, the £1 million per individual will not be transferable between spouses on death. Although we and many of the professional bodies have responded to the consultation, arguing that that allowance should in fact be transferable. This non-transferability is different from other IHT allowances which can be transferred between spouses on death. Any value over and above that £1 million allowance will receive 50% relief, and the 50% that remains will be taxable at 40%. So that gives an effective rate of inheritance tax of 20% on the value of APR and BPR qualifying assets over £1 million. So that's clearly an increase from the current 0% effective rate on those assets, but it's still half the main rate of IHT, so it's still worth securing if at all possible. Whilst those new rules aren't enforced yet, they could affect gifts that you make now. So if an individual makes a gift on or after the 30th of October last year, which was budget day, and dies after the 6th of April 2026, and within 7 years of making the gift, the new £1 million BPR allowance would apply to that failed lifetime gift. Contrary to what we thought when the announcement was first made, that £1 million allowance is not a lifetime allowance, and instead it refreshes every 7 years in the same way as the normal nil rate band. So there's the ability to transfer assets over an extended period of time to make use of that allowance refreshing. You can see on the slide there that that trusts potentially have their own allowance. The rules relating to trusts are complicated and depend on whether the trust was created before or after budget day last year, 30th of October, and new trusts are expected to have to share that £1 million allowance. So those are the changes from April 2026. A year later, from April 2027, pension death benefits will be included in estates for IHT purposes. And Terry's going to talk later about these changes and how it might influence which assets you use to fund your lifestyle in retirement. So I've explained how the rules are changing, but what could that mean for you? We think the best way to demonstrate this is with a case study, which Mike is going to talk through now.
Thanks, Dan. So our case study is intended to help us demonstrate the impact of the changes in the rules and how the potential inheritance tax exposure could be mitigated by implementing some tax planning ideas. So whilst it will not match your specific circumstances, we hope it just helps bring things to life and illustrates the impact of the changes and give you some ideas about the steps that you could be considering. So turning to the case study, we have Mark, who's 62, and Jane, 60, who are a married couple. They have 2 children, Helen 30 and John 27. Helen is married to Peter with 1 child, Poppy, aged 3, but Mark and Jane have some concerns about the stability of Helen's marriage. Helen works in the family business, Nexora Trading Limited. John is in a long-term relationship with Sophie, but without any children. And John does not work in the family business, but is instead employed by a major bank. Their current wills leave all of their assets to the surviving spouse and then to Helen and John equally. In terms of assets, Mark and Jane's total assets are worth approximately £5.5 million and comprise shares in the family business, Nexora Trading Limited. All the shares in the company are currently owned by Mark and are worth approximately £3 million. The main home worth £1.2 million, which is mortgage free. Some ISAs and cash of £300,000, and the house, cash and investments are all held jointly. They also have total pensions of £1 million, which are split £650,000 to Mark and £350,000 to Jane. So whilst we appreciate this case study will not reflect your personal situations, hopefully you can relate to this in your circumstances and see how the changes could affect you and how the tax planning we talk about could be relevant. So I'll pass back to Dan just to go through the impact of the changes on those case study examples.
So as Mike's explained, we've got Mark and Jane with approximately £5.5 million of assets. And based on today's rules, the full value of the business, that £3 million, is exempt from inheritance tax, as are their pensions, meaning £4 million of their £5.5 million of assets are exempt from tax. And broadly, that leaves the value of the house, cash and investments that total £1.5 million potentially exposed to inheritance tax. After deducting the nil rate band, the tax-free amount of £650,000 between them, £850,000 of their estates are subject to tax, and that means £340,000 of tax will be payable. And due to the way their wills are structured, this tax will be payable on the second of their deaths. If we think about what happens from April 2026, because they leave all of their assets to the survivor and the £1 million BPR allowance is not transferable, only the first £1 million of value of the company is exempt, and the remaining £2 million qualifies for 50% relief. So this gives total BPR, as you can see on the slide, of £2 million. The changes to the BPR rules from next April increase Mark and Jane's IHT exposure by £400,000, which is 20% of the £2 million over the £1 million allowance. So as you can see, this more than doubles Mark and Jane's IHT exposure from next April. If we then move on to April 2027, the pensions then come into the IHT net as well. And this means an extra £1 million of value being taxable, and so an extra £400,000 of IHT. So by the time the new rules are fully implemented, the increase in inheritance tax compared to today is £800,000, as you can see at the bottom right-hand corner. And there's been a more than 3 times increase in their overall exposure. And the effective rate of tax on their estates increases from just over 6% to over 20%. As I'm sure you can see, these changes are going to have an impact on Mark and Jane and potentially you as well.
Thank you, Dan. So we now have a first poll, but perhaps before that, again, in terms of asking questions, so there should just be a reminder pop up on the screen while the poll is set up. So in terms of the poll, we just ask you to indicate what level of impact do you think the inheritance tax changes will have on you, being no impact, little impact, or significant impact. And I can see the bars moving quite rapidly. So we'll just leave that on the screen just for a few more moments. We're up to about 70% voting so far. So perhaps if we call it there, so if we can just go back to the poll outcome, it was broadly 1/3 was little impact and 2/3 significant impact, which I think is probably not unrealistic. So in terms of our next speaker, I'd like to invite onto screen Gemma Spencer, who's going to talk a little bit more about some of the legal considerations. Dan, was there any other bits you were going to cover on the IHT planning first?
before we move on to the legal bits, Mike, we were just going to think about some of the broad concepts that people need to have in mind, whether that's for Mark and Jane in our case study or for you personally. So to start with, for gifts to be effective for IHT, they must be made with no strings attached, and the person making the gift cannot retain a benefit. If you retain a benefit from an asset you've given away, the value stays in your estate for IHT purposes. When we think about inheritance tax planning, because you can't retain a benefit from the assets that you've given away, you need to look at your future income and capital requirements to make sure that you can maintain your lifestyles. I think it's really important to remember that the decisions that Mark and Jane in our case study or you might take will not all be about tax. If you're thinking about giving away assets, are you happy for these to go to individuals? Depending on the age and makeup of your family, do you know who's going to benefit today, or do you want to have some flexibility? Do you think your beneficiaries are old enough or responsible enough to receive significant value? And perhaps do you want to be able to say how the money is spent, perhaps on buying a house, but not on fast cars and holidays? And as we've seen in our case study, Mark and Jane have some concerns about Helen's marriage, and are you concerned about potential divorce? All of these non-tax factors will affect the planning that you might want to or be happy to implement. And we're going to talk later about the ways in which trusts could be helpful to manage some of these concerns. Whilst we're focusing on inheritance tax and how to mitigate that liability, we need to think about other taxes that might be triggered as a result of transferring assets. Primarily capital gains tax will be the other tax we need to have in mind, but we also need to consider stamp duty, land tax and income tax, both on the gift of the asset and also the future income that the assets generate. Today we're going to use Mark and Jane to demonstrate some of the planning ideas, but these are just a selection of things that might be worth considering, and you may use several of these in combination alongside other ideas. By necessity, the case study is by no means exhaustive and is intended to show how some of those planning ideas could mitigate Mark and Jane's inheritance tax exposure, focusing on the options available in respect of the shares in Nexora Trading Limited. If we were looking at this more widely, we'd also be considering their other assets, but we can't cover everything in the time that we've got. I think the final point here is that it's vital that any planning is tailored to your individual circumstances and what you're looking to achieve. There really is no one-size-fits-all solution. And if the case study doesn't match your situation, there may be different options that are available and more suitable to you. So I'm going to hand over to Gemma, who's going to talk about some of the key legal considerations.
Thanks very much, Daniel. So let's imagine that Mark and Jane come to see us at Creston Reeves. They've provided us with a list of their assets and current values, and they've given us some family background, as Mike's explained. They've brought with them their existing wills. They're not sure if they really need amending, as they're nice and straightforward, leaving everything to the survivor and then on to the two children in equal shares. But it's only when we start looking at them that Mark and Jane realise the wills were written 25 years ago when the children were younger, and their biggest concern at that time was who would look after them. Their company was still in its infancy and they hadn't yet built up much wealth to worry about long-term estate planning. Mark's older brother is appointed as executor, together with an old family friend who happened to be a solicitor at the time, though he's long since retired. This no longer seems appropriate now the children are adults. They get along just fine, so should be able to work together, and I reassure them the children can be both beneficiaries and executors. Mark and Jane recognise that if they don't do any planning, there's likely to be a considerable tax bill when they've both passed away. Whilst much of the planning may involve gifting and transfers in their lifetime, there may also be some changes that they could make to their wills to complement the lifetime planning and mitigate tax. They could, for instance, include discretionary trusts in their wills to ring-fence certain reliefs, and we'll come on to this in more detail later. Trusts in their wills could also provide them with greater flexibility to enable the executors as trustees to finish any lifetime planning that they are perhaps only part-way through. For instance, Mark and Jane may decide to gift certain assets to Helen with the expectation that they will make a similar gift to John in the future, but pass away before that can take place. If Mark and Jane have a letter of wishes to accompany the trust in their wills to explain their plan and outline their eventual goal, the trustees could use this as guidance to pick up where Mark and Jane left off and equalise the position. In the case of business owners, such as Mark and Jane, it's particularly important to consider whether their succession plans for the business align with their succession plans as individuals, and that their wills don't contradict any business agreements already in place, such as any shareholders' agreement. Wills need to be reviewed periodically, or at least when there are any significant changes to a person's financial or personal circumstances, as well as changes in legislation. If not reviewed, this can lead to an outdated will, which may cause lengthy delays in the administration process, costs in putting things right, if that's even possible, bigger tax bills, and in some cases, the wrong people inheriting the estate. So the first thing Mark and Jane wish to do is update their wills to replace their executors and consider will trusts. And when we're reviewing their assets, I note Mark holds the majority in his sole name. I ask whether they have powers of attorney in place, as without them, Jane could find she loses the right to access those assets if Mark could ever lose capacity. Mark confesses he helped his parents with these recently, but hadn't considered that he and Jane might also need them. There's a common misconception that lasting powers of attorney are only needed in old age, and everybody always assumes they will recognise the right time to put them in place. Unfortunately, life has a tendency of throwing the odd curveball every now and then, which can catch us by surprise. Jane says she would feel much better knowing that these are in place. Once in place, lasting powers of attorney can act as an insurance to provide peace of mind in case they're ever needed. They can allow business transactions to continue in the event of incapacity or lack of physical ability, and they can ensure the right people have access to the right information and documents at the right time. So moving on, for business owners, as part of their estate planning, a review should be undertaken of key documents relating to the business. It's important that they align with the terms of the will and to ensure LPAs will be effective in relation to business operations. In Mark and Jane's case, they ought to review their Articles of Association for Nexora Trading Limited to see what provisions are in place for the incapacity or death of a director and update these if necessary. If there were multiple shareholders, then any shareholders agreement ought to be reviewed to ensure there's no limitation on what Mark can do with his shares in terms of lifetime gifting or on death. Though not applicable to Mark and Jane, if the business was run as a partnership, then it would be necessary for the partnership agreement to be reviewed to enable any assets used in partnership to be passed on according to the terms of the will. Moving on, you may wonder why we haven't discussed the residence nil rate band yet. For those of you who are unfamiliar with this term, this is a relief that was brought in a few years ago to satisfy the government's promise to increase the nil rate band allowance to enable couples to give away a combined value of up to £1 million tax-free. Instead of simply increasing the nil rate band, the government introduced the residence nil rate band. It's worth £175,000, which once added to a person's nil rate band of £325,000, it gives you that magic number of £500,000 each. However, it's very restrictive, and in our case study, Mark and Jane will not benefit from it because the relief is tapered away by £1 for every £2 a person has over the £2 million threshold. The combined estates of a couple on second death would need to be less than £2.7 million in order to benefit from any of the residence nil rate band. It's further complicated by the fact that it's specifically tied to property you have lived in during your period of ownership. There must be at least £175,000 of equity in the property, and it must pass to your direct descendants, so children or grandchildren, immediately on death. While stepchildren are included in the definition of descendants for this purpose, it's worth noting that nieces and nephews are not, and neither are children of an unmarried partner. Given the extent of wealth that Mark and Jane have, it's unlikely to be worth trying to secure the residence nil rate ban for them, as they would have to give away over half of their estate in order to benefit from a maximum saving of £140,000. For others, however, it may be worth considering if their estate is closer to the £2 million threshold, especially given that gifts and assets transferred into trust in the 7 years prior to death, whilst taken into account for inheritance tax purposes, are not added back into the estate when considering the threshold for the residence nil rate band. And I think Jo will be coming on next.
Thank you, Gemma. So as Daniel mentioned, based on what we know so far, any unused £1 million allowance for qualifying business assets will not be transferable between spouses or civil partners on death. With Mark currently owning 100% of the shares in Nexora Trading Limited, this would mean more inheritance tax is payable by the family overall. What we don't have is a crystal ball, and therefore currently, if Jane were to die first, her £1 million allowance will be lost. One simple option, therefore, in ensuring the reliefs are to be maximised, is for Mark to transfer some of his shares in Nexora Trading Limited to Jane. The transfer of shares between them is exempt from inheritance tax. Even if Mark does not survive the full 7 years from the date of the gift, the transfer does not have to be considered when working out any inheritance tax liability on his death. Whilst there are no immediate tax costs on the transfer, it is worth bearing in mind that the transfer of shares to Jane will not immediately trigger the benefit of 100% relief should she want to make any lifetime gifts herself. This is because she will need to have held the shares for at least 2 years ahead of any lifetime gift. In contrast, should Jane transfer the shares on her death, then she will not have needed to have owned the shares for 2 years for her estate to benefit from the relief, assuming the other criteria are still met. Considering capital gains tax, a transfer between Mark and Jane will be at no gain, no loss. This means Jane will take on Mark's original cost. By transferring shares now, the family could lose out on the ability to rebase the shares for capital gains tax purposes had Mark held the shares on his death. Mark decides that transferring shares valued at around £1 million would allow them to achieve the best of both worlds at this time, securing the extra £1 million 100% allowance, but also limiting the potential loss of capital gains tax rebasing.
It will be very common for spouses involved in a business together to have wills as Mark and Jane currently do, which leave everything to one another on first death, either outright or on life interest trusts. The survivor then has full use of the business assets, and on their death, those assets would all qualify for 100% business property relief, and the combined estates can also benefit from 2 nil rate bands if needed. This keeps the administration on first death very straightforward, and it may not even be necessary to involve a professional or apply for probate until second death. Couples may still like this option, but from April 2026, it will be less tax efficient, as the £1 million cap on 100% business property relief is not transferable. If everything passes to the surviving spouse, their combined estates will only benefit from 100% relief on the first £1 million of business assets. There's a missed opportunity there. As their wills stand, Mark and Jane would pay no inheritance tax on first death, but would only benefit from £1 million worth of relief at 100%. If, however, they take Jo's advice and Mark transfers at least £1 million of Nexora Trading Limited shares to Jane, and they both update their wills to include discretionary trusts, they could benefit from £2 million worth of relief at 100%. On first death, irrespective of the order in which they die, the first £1 million worth of relievable assets pass into a trust. The survivor would be included as a beneficiary of that trust, so that they could still benefit from the shares without those shares being treated as part of the survivor's estate for inheritance tax purposes. You can see from the next slide that by sharing business assets between them and adding discretionary trusts to their wills, Mark and Jane have managed to reduce their overall inheritance tax bill by £200,000.
Taking the tax planning one step further, Mark could consider transferring some of his shares to his children, Helen and John. These transfers will be a potentially exempt transfer, and providing Mark survives 7 years, the value of the gift will fall outside of his estate. Any future growth in value will also fall outside of his estate with immediate effect. Should Mark survive at least 3 years but not 7, then taper relief could be available. This reduces the amount of tax payable on the gift itself, which would be payable by the recipient of the shares, so Helen or John in this instance. For capital gains tax purposes, the gift would be a deemed disposal at market value. Given Mark subscribed for the shares at par when the company was set up, this would result in a considerable gain, with tax payable at 14% for the first £1 million of gain due to business asset disposal relief being available, and the balance being taxed at 24%. As the company is more than 80% trading, Mark can jointly elect with Helen and John to hold over the capital gain. This allows Mark to transfer the shares to them at their original cost, resulting in no immediate capital gains tax liability, which would otherwise have to be funded from Mark and Jane's savings. We would highlight to Mark that there are a couple of potential downsides to this option. The first is the potential loss of business asset disposal relief, as if Mark dies still holding some shares, this will never have been utilised. And the second is if the capital gains tax rates go up between the date of the gift and the date the company is sold, there would be an overall higher tax cost. However, a lot of clients have the peace of mind that that cost is then matched against the cash proceeds that have been received. The taxes mentioned are dependent on the valuation of the shares being transferred. For inheritance tax, this is based on the difference between the value of Mark's current shareholding compared with what he retains after the gift. We also need to take into account any shares that Jane holds at either of these points in time. For capital gains tax, you look at the value of shares being transferred, which can often be smaller than the value for inheritance tax purposes. One further tax consideration is around employment-related securities. This is a set of anti-avoidance rules which seeks to tax the value of the shares gifted as additional earnings, where the individual that's receiving the shares is an employee of the company. And this can be as a result of their past, future, or current employment. As Helen is employed by Nexora Trading Limited, then this could be relevant in our case study. However, there are special exceptions which exist where the transfer is due to a personal relationship, a family member being part of this example. Whilst the tax position of the proposed transfers are all manageable, Mark should also be aware of the non-tax considerations of such a gift. As Daniel mentioned, for a gift to be effective for inheritance tax purposes, the gift must be unconditional. Mark will therefore need to be comfortable that he is passing along the voting rights of the shares to his children, as well as the possibility of the value of the shares passing outside of his immediate family, even if the shares don't transfer themselves. Aspects such as shareholders' agreements can provide a level of certainty, but it may not be sufficient, especially given Helen's current personal circumstances.
Thanks, Joe. So I'm Tom, and I'm not a tax advisor, but I sit in the valuations team, and I'm here to talk a bit about those valuation concepts that Joe referred to. Today, I'll be focusing on the shares in Nexora that Mark and Jane own, and the beneficial application of valuation techniques to value those, primarily for inheritance tax planning purposes. I won't be going into the detailed theory, but hopefully we'll outline some fundamental assumptions. So Mark and Jane have two real ways of deriving value from Nexora. Firstly, they can continue to generate an income in it, and secondly, they could sell the business for a capital sum now. Now, logically, they would choose the more valuable of these options, which is the higher of those. And international valuation standards define that the value of an asset is its highest and best use. So within the various guidance and standards across all sorts of sources, there are 4 different bases of valuation that I've set up on screen. In reality, there are many more, but today I'll be focusing on the concept of market or open market value as defined in HMRC legislation. So on the next slide, we have the definition of open market value for inheritance tax purposes. And you can see that is the price the property might reasonably be expected to fetch if sold in the open market at that time. Within the actual legislation, there are further nuanced concepts that support the valuation of assets for tax purposes. And included in those for IHT purposes are a couple that Joe's already touched on. One is the diminution in estate concept, and that is that we look at the value of an asset before the gift and the value of an asset after the gift. Now with shares, it's rather more complex than with many other things, because the value of a whole company might be different to the proportionate value of half the company. And the other concept that we'll touch on is related property. And that is the concept that assets owned by closely connected parties, typically spouses, are related and thus must be considered as one overall asset. The case study examples later on will help explain both of those two concepts. So if we can move on to the next slide. Now within these various approaches to standards, all valuation standards, the guidance sets out three primary approaches, and these are set out on screen. Firstly, we can look at a market approach for established trading businesses, and that is comparing its profits using market multiples to those of other transactions. We apply the multiple to our own profits to generate what we call an enterprise value. That's a trade value of, here in my example, 2.4 million, and we adjust that for cash and debt to come to the 3 million that Nexora is valued at. The next methodology might be the income approach, and that's often based around a discounted cash flow. We look at the future income that that business is going to generate, and we work out what the present value of those cash flows will be. Again, I've come to a value of 2.4 million for the enterprise value, to which we adjust for net cash, coming to the equity value of £3 million. And the final, which normally isn't used for trading companies, is the cost basis, which effectively means that every asset and liability within a company needs to be replaced and can be done so for the cost on the balance sheet. And typically this undervalues profitable trading companies because it doesn't recognize the value of those profits. So if we move on to the next slide, you'll have seen that approaches 1 and 2 are quite similar in that they both relate to trading companies and they both relate to profitable trading companies, whereas approach 3 is very different. Now, all three are very simplified models that I put up on screen. In reality, there's complications around all of those methodologies, but that's what we can help you with. So, moving on to the next slide, Joe mentioned diminution in estate principle. And to understand this, we need to explore this concept of what we call a minority interest discount. And again, a definition of this I've put up on screen. So a minority interest discount refers to a reduction in the value of a minority stake in a company due to the lack of control and influence over the company's decisions and when that investment can be realized. This actually breaks down into two pieces, which are shown on the next slide. The first element is the lack of control. So if I hold a holding of, say, 10% in a company, I don't have any influence over how that company is run, and thus I can't protect the value of my own investment. So we discount my investment for that. And secondly, particularly with private companies, I haven't got an ability to realize that investment. I can't sell it immediately on a stock market or anything like that. So there are two elements of this. I'm not going to therefore pay 10% of the total company value for my 10% interest in that business. In fact, I'm going to pay a very significantly discounted value against that. And that discounted value is seen both in practice through real transactions in shares, but also has been set out to some degree through case law in tax cases. So if we move on to the next slide, although each case is different and the other shareholders will have a bearing on the discount that we apply, you can see that the range here can be extreme in that we could apply a discount of 70% or more to a holding of my 10%. So if it was a gross value of £100, I'd only be paying £30 for that interest. Now that is useful, particularly in capital gains tax, but it also has an important bearing on inheritance tax. Some of these levels are set out in previous case law, as I mentioned, but the circumstances of those cases differ. So every time we go into an assessment of a minority interest discount, we need to look at the particular circumstances of that business and who the other shareholders are. And while there's a general sliding scale from a 0% discount for absolute control, there are to my 70% for a very small control, there are some significant steps in there as well, particularly at the 25%, 50% and 75% control thresholds, as these come with rights to protect my investment. So on the next slide, I've set out an example for Nexora. If we imagine a circumstance where the combined holding is 100% of the value, then the value will be 100% of the company value. However, if we imagine a 40% holding, using my example, that may only be worth £720,000 rather than 1.2 million. And a 10% holding may have a value of only £90,000 rather than a £300,000 holding. So for the diminution in estate value principles, we work out the difference between those two values. So the diminution in the estate value, if I were to give away 30% to go from a 40% holding down to a 10% holding, would be £630,000. That's 720 minus £90,000. Now, as Joe's mentioned, this may well be covered because it's been given away in my lifetime. It may be subject to taper relief as well. But it's something that we do need to consider at this stage. So that's an example of how the diminution in estate value works. On the next slide, I've actually set out an example that compares the value of Mark and Jane's estate on their death if they transferred different proportions of their interest to their children. As you can see here, the gross value of the holding reduces from 3 million in the second row down to 2.4, 1.8 and 1.2 million as 20% tranches have been transferred. And you can see the impact of this in the third row down on the minority interest discount. You can see the discount applied starts at 10%. That's applicable to an 80% holding. It reduces to 25%, and then it reduces to 40%, increases to 40%. So the minority interest discount gets bigger and reduces the amount of their investment in their residual estate. And as that value of that residual estate drops, you can see that it drops to a point where it's actually covered in full by the business property relief band. So in the first circumstance, under the 20% transferred scenario, we've got a value of 2.4 million, which is reduced by £240,000 to 2.16 million. Now that's not all covered by business property relief. The first 2 million would be, but the excess of 0.16 million is only 50% covered. So the relief is 2.08 million, and there's a little bit left in their estate. Whereas in scenarios 2 and 3, the level of minority interest discount and the applied to the value of the estate means that the total value of those shares will be less than £2 million, and therefore those holdings will be fully covered by BPR. So as you can see at the very bottom of the screen, this actually has a significant impact on the estate, the tax on death. In the first scenario, the improvement is £168,000, and in the second and third ones, the improvement is £200,000. Now, I appreciate that's complex, and it's not in this scenario to go through that in greater detail, but hopefully that sets out the principles of this. And now I think I'm handing back to Joe for the next session.
Thanks, Tom. So Mark has indicated that he's concerned about transferring his shares directly to the children, especially given Helen's circumstances at this present time, as we've already highlighted. He's also keen for Poppy to benefit from some of the dividend income directly, and therefore he wants to understand his other options. This led to us discussing the benefits of using the trust in his circumstances. And using Tom's valuations, he'd be keen to transfer 40% of the shares of Nexora Trading Limited for the benefit of his children and the next generations, which allows him to retain control at 60% between himself and Jane. So if we're focusing on the tax side, up until the 6th of April 2026, there would be no immediate tax costs in transferring these shares, irrespective of their value. And this is due to the transfer benefiting from the current inheritance tax rules that Daniel mentioned earlier. In addition, a transfer of any chargeable assets to the trust can also benefit from capital gains tax holdover relief. The assets held in the trust will not form part of any beneficiary's individual estate, which can help with wider tax planning, especially given Helen and John might become quite wealthy in their own right. If dividends are to be paid to the trustees as shareholder, that income could be directed to Poppy or other future grandchildren in due course. This allows for further use of the family tax allowances. Whilst the tax benefits are clear, it's important to understand that the trust does have its own reporting requirements, and therefore administration of the trust, including accounts and tax reporting, needs to be factored into any decision as to the appropriateness of this structure. Further, trusts do come with their own tax regime, and for inheritance tax, there will potentially be a tax charge every 10 years and when capital is distributed out to the beneficiaries. This is currently a maximum rate of 6%, so it would take a considerable length of time before it matches the 40% inheritance tax death rate.
People can often be very wary of trusts, and they're not right for everybody, but they can be very effective if used in the right circumstances. We've seen how they can be useful from a tax perspective, but there are other non-tax related advantages to the use of trusts. They provide asset protection for vulnerable beneficiaries, such as those who would be easily influenced to part with assets, perhaps because they're in a controlling relationship or suffer from alcoholism or other forms of addiction or mental health issues, where it wouldn't be appropriate for them to be in receipt of significant capital. There could be doubts as to the stability of the individual's financial or matrimonial circumstances, and trusts, whilst not watertight on divorce, do add an extra layer of protection. The shares transferred into trust for the benefit of Helen and John, or the grandchildren, will not be held in their individual names. If in their individual names, Mark and Jane would have no say over what happens to the value of those shares on the divorce of Helen or John if he should marry his partner in the future. Also, if either one of them should face financial difficulty in the future, those assets would stay out of the hands of creditors, and it's certainly too early to tell how financially mature the grandchildren will be. So a trust would address all of these concerns. Trusts are very flexible and can be really useful in allowing people to leave the decision until later. If you have the right person making the decision and you trust them, you can provide them with notes of guidance and leave them to make the decision based on circumstances relevant at a later time. This can be particularly useful with family businesses, where the owner would like to see the family business continue, but the children or grandchildren are not yet ready to take on that level of responsibility. Trusts can allow for that extra time to pass so that beneficiaries inherit when they're suitably prepared. In the case of John, he has shown no interest in the business just yet, but things can change, and this might give him an opportunity to prove himself if he decides to join his sister in the company at a later date. Trusts also allow for the person setting up the trust to retain some element of control, and in the case of lifetime trusts, they can remain in the driving seat as a trustee. This can be particularly useful with shares in a family company, as the trustees, whilst unable to benefit personally, can retain use and control of the shares. So for instance, if there was a sale opportunity, it would be the trustees who drive any decision based on the voting rights of the shares they're holding and not the beneficiaries of the trust. But trusts aren't for everybody, and despite the tax and other advantages, as Joe's explained, trusts come with reporting requirements and other responsibilities which can place a heavy burden on trustees. It's also dependent on having the right people that can be relied upon as trustees who will be able to understand and follow directions. In the case of will trusts, a surviving spouse might feel very uncomfortable about not inheriting outright and having to share decision-making with somebody else. Ultimately, it will depend on the individual circumstances of the client as to whether a trust is right for them. And because I like dogs, I've included this next slide just for a bit of light relief. There's a lovely saying, which is, don't let the tax tail wag the dog. Now, sadly, we can't offer a one-size-fits-all solution. As we've all explained, there are various factors to consider, and each person's circumstances need to be taken into account when considering the suitability of trusts. The points listed on this slide would need to be explored with Mark and Jane, along with the tax considerations that we've already discussed, to determine whether trusts are right for them. And the next slide helps us to see how Mark and Jane's estate could benefit further if they do take our advice and Mark transfers 40% of the company shares into a trust in his lifetime, in addition to setting up the will trusts. You can see that this will give them an additional saving of £200,000 with no upfront tax costs. And then I think it's back to you, Tom.
Thank you very much. Thanks, Joe. Thanks, Joe. So far, our planning has assumed there'll be no growth in the value of the company prior to the death of the individual. However, typically businesses grow in value. And on the next slide, we consider if there's anything that can be done to protect the holders of those shares from tax on this future growth in value. One opportunity in this area arises from the concept of growth and freezer shares. I'll start with the consideration of the main rights attached to ordinary shares. These are voting rights, dividend rights, and capital rights. Now, each of these contributes a bit of value to the value of those shares, and planning can be undertaken to vary the level of that value. Whilst the overall company value will remain the same, probably, if multiple classes of shares are an issue, the class rights can be varied to allocate more or less value to each class. For example, classes of shares can have no voting rights or multiple voting rights. Alternatively, they may not be entitled to dividends or may attract a preference fixed dividend. Finally, different classes of shares can be entitled to different proportions of any proceeds arising on a disposal of the company. This is often referred to as the waterfall. And classes attracting a greater proportion of those proceeds will naturally be worth more than those attracting a smaller proportion. And the next slide introduces how we might model the value of such growth shares. This is a very complex area of theory, but an option pricing model is used to split the total company value between that that's derived from future growth and that which arises from the current position. The graph at the bottom right demonstrates a typical distribution of an estimated company value on an eventual exit in a number of years' time. The value of those growth shares is therefore calculated based on the graph by the deduction or the application of the waterfall, the deduction of the freezer value, and assessment of how likely each exit value is. The next slide then continues the example for Nexora. So here we've got a company value of £3 million. We'll assume a growth threshold of £3 million, a 5-year holding period, no dividends, and a 4% risk-free rate. That's roughly the current UK government gilt rate. We then need to undertake something called the volatility, which is the variability of a share price to the market, the fluctuation day on day. And in this case, we've assessed that at 35%. Now, simplistically, in this model, the value of Nexora remains £3 million, but an application of those assumptions means that roughly 1 million of that value is split to the growth shares and 2 million is frozen in the freezer shares. Now, that split could be adjusted further by considering different class rights, the level of votes or dividends, by allocating some of the growth rather than all of the growth to the growth shares and actually retaining some of the growth value in the freezer shares, or allocating only an element of those shares out, or changing the growth threshold. So instead of having to get above 3 million to participate in growth, the growth shares might have to get above 4 or 5 million. And an example of that is if we change that hurdle from 3 million to 4 million, we'd actually reduce the value of the growth share element from £1 million to £500,000, leaving £2.5 million in those freezer shares. Now, finally, the model only considers the split of the total value of Nexora between the different classes of shares, and therefore the minority interest discount I referred to earlier also remains applicable, so we can bring those values down for smaller holdings. If we can move on to the next slide now. If we consider the scenario where Nexora's value on death is £5 million, if growth shares are not set up, the inheritance tax would be 5 million, 2 million of that would be covered by BPR, and 50% of the residue of 3 million would be covered by BPR also, meaning there'd be 40% tax on 1.5 million, £600,000. Whereas if growth shares have been created and, say, gifted into trust, then the inheritance tax would be frozen on £3 million. 2 million of that would be covered by BPR and 50% of the residue, 1 million, meaning that tax would only be 40% on £500,000 or £200,000, and tax saved would be £400,000. There is a slight trade-off in this, in that obviously by giving away gifts, you're creating a potentially taxable lifetime event. Now, again, I appreciate this is a complex area, but hopefully that's outlined how it might work. Now, if we move on to the next slide, this summarizes that position, just the continuation of that example. So here you can see in column 2, we've frozen the value of Nexora at the date of death, £3 million. The business property relief is £2.5 million, and the overall reduction in the tax liability is £400,000. And I think now I'll hand back to Dan.
Thank you, Tom. So we've been through our case study, and given their desire to transfer value whilst providing asset protection and retaining flexibility, Mark and Jane have concluded that the right course of action for them is to create the growth shares that Tom has just talked us through that benefit from the future growth in value of the business, and for those growth shares to be transferred into a discretionary trust for the benefit of Helen, John, Poppy, and any future grandchildren. And that provides the asset protection and control and flexibility to provide for future grandchildren and provide an element of protection in the event of divorce and things. In addition to creating the growth shares, they've also decided that they would like to gift 40% of the ordinary shares, the freezer shares, into trust as well. And assuming that the company qualifies for 100% BPR today, and you'll remember I talked about that 50-50 test at the beginning, and there's no restriction, those transfers into trust can take place with no upfront tax cost. We would then split the remaining shares between Mark and Jane, so they both have access to the full £1 million allowance, and update their wills to include discretionary trusts to make sure that we use that allowance on the first death rather than the assets passing to the surviving spouse. As Joe explained, there are some quite complex rules around ownership periods for shares, so we'd need to be careful about the sequence of events, and it's likely we'd need to deal with the transfers into trust before the transfers from Mark to Jane. So what's the impact of implementing these various planning steps? If we continue to use Tom's example that the value of Nexora increases in value from the current £3 million to £5 million, if Mark and Jane don't do any planning, all of that increase will be inside their estates. And the reduction of BPR and the inclusion of the pensions in their estates would mean their tax liability would be £1.54 million after April 2027, when the new rules are fully effective. And with the exception of the trading company shares, that doesn't factor in any increase in the value of their other assets, which would also increase their exposure further. If they implement the planning that we've recommended, their exposure could reduce to £740,000, a reduction of £800,000 compared to taking no action. And this is a result of the value of the freezer shares being capped at £3 million, that hurdle rate that Tom talked about, and all the value over that accruing to the growth shares that are outside of their estates having been transferred into the trust. 40% of the freezer shares, the £3 million, are also in trust, and then there's a further reduction of by £450,000 because of the minority interest discount, because of the lack of control, influence and marketability that Tom's talked about. So we're looking at that from Mark and Jane's perspective. If we think about it from the trust perspective, the headline value of the trust is then £3.2 million, which is the £2 million of value of the growth shares and £1.2 million of freezer shares. But that will be subject to minority discounts that would reduce the value, at least for tax purposes. As I said at the beginning, this is a case study to illustrate the potential impact of tax planning and only really considers planning with the trading company shares and not their wider assets. But I hope this demonstrates how, with careful planning, the impact of the changes to the inheritance tax rules can be mitigated. And these ideas and others may be relevant when considering your own situation. So I'm now going to hand over to Terry, who's going to talk about the role of insurance, changes to inheritance tax treatment of pensions, and the benefits of using cash flow projections to help with planning. Over to you, Terry.
Yep. Good afternoon, everyone, and thanks, Daniel, for that. So I'm going to have a look at the use of life insurance in inheritance tax planning first. So the life insurance plays basically two key roles in inheritance tax planning. Firstly, it can provide funds to pay inheritance tax liability on the estate. When making lifetime gifts, combining the gift with life insurance removes the liability immediately, rather than having to potentially wait for 7 years for gifts to become exempt, with insurance premiums representing a fraction of the cost of the potential inheritance tax liability you save. When using life insurance to pay inheritance tax on death, the insurance premiums represent an additional lifetime expense. However, they will generally be cheaper than paying the inheritance tax bill from the estate and can be capped at a maximum level. The premiums themselves will also serve to reduce the overall level of the estate on death that is subject to inheritance tax. The second benefit is that life insurance may provide liquid funds outside of the estate to pay the tax due. This allows the beneficiaries to meet the cost of tax without needing to sell important assets or raise finance to pay the tax, which may compromise the continuity of a business or the continued ownership of property or treasured assets. Writing the policy in trust results in the funds being available outside of the estate almost immediately, avoiding the delay in application and granting of probate and making funds available to pay the tax due and release assets from the estate quicker. In essence, life insurance may ensure the right amount of money to pay the tax is available in the right hands, at the right time. Now, there are three different policies that we could use in protecting inheritance tax through life insurance. The first is level term assurance. This is used to protect the loss of the nil rate band on lifetime gifts until they become exempt after 7 years. The amount of cover is equal to the inheritance tax payable on the gift if it fails, and the risk is limited to 7 years only, meaning that the premiums may be relatively inexpensive. Gift inter vivos insurance. This again covers inheritance tax payable on failed, potentially exempt gifts. The sum assured decreases in line with the available taper relief, which therefore provides a cheaper alternative to level term assurance for gifts above the nil rate band. And lastly, whole of life cover. This is cover for life and pays out the sum assured on death to provide funds to pay all or part of any inheritance tax due. As such, the premiums will be more expensive and may continue for longer than the level term or gift inter vivos cover, but should still be cheaper than paying a tax from the estate over time. So the next slide looks at how we can use these types of policies to protect what Mark and Jane are going to do. So let's imagine Mark gives 40% of his shares to a family trust, as discussed by Daniel. And in this simple example, we consider the gift is valued at £1.2 million for inheritance tax purposes. So you can apply this principle to other assets they may gift. Whilst the gifts are moved out of Mark's estate, they may be counted back in for inheritance tax if he dies within 7 years, where business property relief is lost. So if Mark continues to carry a potential inheritance tax liability of up to £480,000 for 7 more years. To cover this liability, we can first use a level term assurance policy to cover the gift that will use up Mark's available nil rate band of £325,000. As this part of the liability will not reduce, a potential tax charge of £130,000 will be covered in full for the 7-year term. The remaining £875,000 of the gift will benefit from taper relief after the first 3 years. This will reduce the tax liability by 80% after the 3rd anniversary, and then a further 20% annually thereafter. As such, a gift inter vivos policy is a specialist type of decreasing term insurance which can be used to provide sufficient cover at a relatively lower cost than a level term insurance policy, while still providing full protection over the 7-year period. The next slide looks at the costs of cover in this example, based on Mark as a non-smoker with no health conditions and age 62. The cost-benefit analysis involves comparing the total premium cost of £10,334 over the 7-year term for the combined policies against the risk of paying up to £480,000 in tax if Mark dies prematurely. In essence, the combination of gifting and the combined life insurance has provided a guaranteed immediate saving of just under £470,000 against a future inheritance tax liability. We'll come on to whole of life insurance a little bit later, but next we're going to revisit the changes to inheritance tax and pensions, which will come into effect from April 2027. As you may recall from our last webinar, due to the current benefits of pensions falling outside of their estates, many clients have actively funded pensions with the intention not to use them and allow assets to be passed on free of inheritance tax on death. However, from April 2027, pension assets will form part of the estate. So if you could just move on to the next slide. And any excess pension benefit above its share of the nil rate band will be subject to inheritance tax at 40%. Where the pension holder dies after age 75, a further income tax charge may be made on the beneficiary at their highest marginal income tax rate when they draw their death benefits, either as a lump sum or later via a drawdown pension. Dependent on their personal rate of tax, the total effective rate of tax on pension benefits in the hand of the beneficiaries after death may be up to as much as 67%. So, if we can move on. So how can we plan for the future? Well, we can use cash flow modelling to help understand how best to fund your retirement and mitigate these tax changes by comparing different options. Rather than just looking at current values, cash flow forecasting allows you to project future values and takes into account the impact of future events and planning options based on the assumptions used. This may help you to understand your future income and capital requirements and how much you can afford to gift or spend on insurance to mitigate inheritance tax. However, we need to be aware that the outcomes are not guaranteed and will be subject to changes in the assumptions used, and so regular review is sensible. Currently, Mark and Jane expect to fund their lifetime expenditure from ongoing dividend income from their business. This is represented in the income block shaded in the lovely brown we can see on the screen. And then their future state pensions, illustrated in blue, will kick in from their respective 67th birthdays. This provides an expected surplus of income above their total expenditure, indicated by the black total need line running across the term of the plan. Overall, the plan is being increased in line with an inflationary measure to take into account future inflation. Over the course of this projection to age 90, there are no shortfall in Mark's and Jane's income requirements. The next slide looks at the assets behind the picture. Where we assume that any surplus income is accrued and reinvested, their assets may continue to grow. This offers the opportunity for them to increase their standard of living in retirement, make additional lifetime gifts, and provide financial security to future changes, such as the need for long-term care later in life. In this example, we assume that Mark and Jane continue to defer access to their pension benefits. By their 90th birthdays, they have retained and accrued combined assets of £9.4 million. As we move on to the next slide, we can consider how the changes in the treatment of pensions from April 2027 affect their beneficiaries when Mark and Jane die after age 75. The planning around their company shares allows them to continue to fully benefit from business property relief. Prior to 2027 changes, the accrued pension assets outside of the estate would escape inheritance tax, although they would become subject to income tax in the hands of the beneficiary where Mark and Jane die after age 75. After payment of inheritance tax and drawing benefits from the pension subject to income tax at the highest potential rate of 45%, in this example, the beneficiaries may receive net funds from all of their assets of circa £6.4 million, including growth from day 1 to age 90. However, following the proposed changes in April 2027 in the second column and the inclusion of pension benefits in the inheritance tax calculation, if Mark and Jane continue with this strategy, the total tax take increases to circa £3.9 million, and more importantly, reduces the net benefits received by their family by over £900,000 at this future time. So how can we get around that? The next slide looks at ways of taking money out of the pension. So Mark and Jane, to reduce this tax grab, will consider some additional planning ideas. Firstly, they decide to draw pension income at a rate of £35,000 each. Up to 25% of this income drawn may be tax-free, of course, with the rest taxable at their highest marginal rate of income tax, which in this example was 20%. One drawback, however, is that the additional income tax will have push the highest rate of income tax payable on their continued dividend income up to 33.75%. They then gift £1,000 per month to their children or into the existing trust to remove these funds from their estate. These gifts may be exempt immediately where they qualify for the gifts from surplus income exemption, or may be considered potentially exempt gifts and fall outside of their estate after a further 7 years. The next slide shows them also thinking about putting in some whole of life insurance into place. So here they decide to use £6,000 of their surplus income each year to arrange a whole of life insurance policy. The premiums for the policy may fall outside of their estate immediately if using the annual gift exemption at £3,000 each, and they may enjoy this cover, which may cover the premium costs. The sum assured of £443,000 paid out on the second death costs a total of £168,000 in premiums up to age 90, offering a potential tax saving of £275,000 before adjustment for inflation and a reduction in the estate value of the premiums paid. The premiums in this example are guaranteed not to change, whereas in some plans reviewable premiums may be allowed to increase the level of cover over time. The policy is written under a suitable trust arrangement to remove the funds from the estate and escape inheritance tax, and allow the sum assured to be paid to their family without the need for probate, which can be then used to pay any part of the inheritance tax liability outstanding on death. The revised cash flow forecast on the next slide shows that Mark and Jane will still enjoy sufficient income. We can see the increase in income from the additional pension income, and their current standard of living will not suffer, with the insurance premiums and regular gifts affordable from the increased surplus income. By age 81, all of the pension funds are spent, and Mark and Jane stop their regular gifts but continue to pay the whole of life insurance premiums going forward without any income shortfall. The assets behind the graph on the next slide show that the impact of this additional income and gifting means that they will still accumulate wealth over time. However, where their assets are held changes, with pension assets being spent and alternative cash savings and investments being accumulated. By age 90, their wealth has increased to circa 7.3 million, which is some 2.1 million lower than their current forecast discussed earlier. Given the value of assets that Mark and Jane have still accrued, they are confident that they will have retained the financial security to cope with future changes in their personal circumstances and family events, whilst also taking steps to mitigate inheritance tax. Of course, if we had more time today, we could also consider further events in the future, such as downsizing the main home, the impact of additional lifetime gifts at a later date, increasing the life insurance cover, and also considering their income and capital needs following the death of the first spouse and the impact of long-term care costs for either party. These projections should be reviewed regularly to aid that future decision making. Finally, we look at the impact on the inheritance tax that these changes have made. Whilst Mark and Jane's asset wealth is lower by age 90, the position on death is improved as the beneficiaries will receive a higher net value of assets. On death, the inheritance tax liability is reduced to a lower estate value, and which is partly due to the impact of higher spending on gifts and insurance premiums. And with all pension assets spent, the beneficiaries will receive assets which are not subject to additional income tax following the initial inheritance tax liability. In addition, if we count in the accumulated lifetime gifts paid of over 228,000 and the additional life insurance payout on death of 443,000, these are not captured for inheritance tax. This results in an outcome where the beneficiaries may receive an additional £500,000 in net asset value over time, with the lifetime gifts also offering the additional financial assistance earlier in life. So thanks for listening, and I'll pass back to Mike.
So thank you, Terry, and all the other presenters for their contributions. Just a final reminder to keep your questions coming in thick and fast whilst we have our second and final poll. So having heard the presentations, was just a poll to check in on what your priority is over the next 12 months. Reviewing your will, reviewing or transferring assets, obtaining a business valuation, undertaking a pension review, or all of the above. So we'll just leave that up for a few moments whilst the votes start coming in. So it's fairly sort of mixed actually. So yeah, predominantly all of the above, but perhaps some individuals will have more focus on certain areas than others. So just moving into our question and answer session, which have been coming in as our presenters have been speaking. So as I say, please do continue to submit these. If we can't get to answer all of your questions today, then we'll answer them after the webinar. So in terms of some of the questions, so we have a question from Callum. My will is with my former solicitors. Do I need the original in order for you to review it? So perhaps I can ask Gemma just to cover that one.
Sure. No, I mean, a copy is absolutely fine. And in fact, if you then go on to make any changes and we make a new will, it would automatically revoke the old one. But my recommendation would be don't leave it where it is. Once the new one's made, make sure you get it, because otherwise you've got lots of different versions out there, and it would be awful if somebody mistook that for the latest one and proved the wrong will.
And it is quite an important document at the end of the day, Gemma, as well, isn't it, in terms of applying for probate. So we have a question from Emily. Why is there an opportunity to transfer assets into trust now, but this will not be possible in the future? So perhaps I could invite Jo to answer that one.
Thank you, Mike. You can still continue to transfer assets into trust after the 6th of April 2026, but the value that you can put into it would be restricted if you didn't want to pay an upfront lifetime inheritance tax charge. So at the moment, we're governed by the current 100% relief rules, which we talked about earlier, but with effect from the 6th of April 2026, we would have to apply the £1 million allowance at 100%, and then any surplus value would be subject to a lifetime charge on that element.
Okay, thank you, Jo. A question from Mark. I have a trading company that also owns a commercial property that we used to trade from. This is now rented out. What impact could this have on my inheritance tax position and the options that might be available to me? So Dan, that's probably one for you.
Yeah, thank you. Thanks, Mike. This comes down to the point that I talked about earlier about the qualifying conditions for business property relief. For a company to be qualifying for business property relief, it must be wholly or mainly trading, so more than 50% of the assets, profitability, turnover, management time when looked at in the round. It really depends on how significant the value of that commercial property is today compared to the value and other activity within the company. If the value of the property is relatively small compared to the rest of the business, then it won't have a significant impact. If it's more than 50%, that could mean that BPR isn't available at all. And Joe talked about the ability to hold over capital gains on an outright gift of shares to individuals. Helpfully, the test for holdover relief is different from the test for business property relief. That's an 80% test. So if the value of the property is significant, it may prevent holdover relief being claimed on a gift of those shares to individuals. So it really depends on the respective value of the property compared to the trading business.
So as always, it depends on the detail then, doesn't it? So
as almost always, yes.
Yep. So from Carol, what will the tax implications be if I transfer shares in my trading company to my children after April 2026? So Joe, perhaps I could ask you just to cover that one.
Yeah, certainly, Mike. So as Dan mentioned earlier, should you make a gift now and then die after the 6th of April 2026, the new rules will come into effect, assuming that you do not survive the 7 years. So if you're transferring qualifying assets at any point from now onwards, and you survive the 6th of April 2026, we will have to take into account the £1 million allowance at 100%, and then any surplus value will be subject to a 50% relief, assuming the asset itself still qualifies for business property relief at the time of your death.
Okay. One for Terry.
There, Mike? Sorry, can I just add there that I think as Joe's explained with those two questions, we've got this change in the rules from 6th of April next year. So if the shares would not qualify for holdover relief on a gift to individuals because it doesn't pass that 80% test, transferring into trust gives you that ability to hold over whatever the type of asset. So there's potentially a window of opportunity between now and April next year to transfer assets with no upfront inheritance tax or capital gains tax, and that may not be available after the 6th of April next year.
So action sort of now is the general advice.
Yeah.
One for Terry. So changing tack a little bit, but how might long-term care costs affect estate planning decisions, especially in relation to protecting assets from inheritance tax? That's from Matthew.
Yeah, I think the key thing is making sure that obviously you're retaining enough assets for your own lifetime needs. That it also includes things that we can't really foresee happening at this moment in time. So we can sort of help you look at that through the sort of lifetime cash flow forecasting we can do as part of your financial planning. Of course, we've got to be careful if you deprive yourself of assets purely to try to avoid long-term care. You can get caught out by the deprivation of assets rules, which the local government will look at to make sure that you're not just giving assets away to get rid of long-term care costs if that's likely to happen in the short term. So the sooner you give money away, if you can afford to do it, the better.
Okay, thanks, Terry. Tom, one on tax valuations. So what's your experience of HMRC investigations into tax valuations? And I suppose the corollary of that is the outcomes that you've experienced as well.
That's an interesting question. We often go on valuation conferences and regularly have presentations by HMRC officers who are on the other side of this about their experience and how they go about their inspections into valuations. They admit there is a lot of pressure on them. That is something that they are under all the time. There is definitely a degree of risk profiling that they undertake in selecting the valuations that they do. But they do say that typically, if a valuation has been done independently using recognised valuation models, and that they're getting more sophisticated, so they do look at option pricing models that I referred to earlier for growth shares and that sort of thing, and they fall within, they use the phrase sort of normal parameters, then those are often seen as low risk assignments and subject to quantum, and quantum obviously is always a big thing. They may well just not have the resource to go through it. The next step is obviously when they do inquire into it, what's the response there? Well, typically the inquiries we get are to start with well, very few. I was talking to my partner in the team who also does valuations, and we've had very few inquiries into our valuations over recent years. Where they do come in, it's normally a couple of small aspects that they just have a couple of questions on, and normally the pushback that we give them means that we get back to the original position anyway. So there is a valuation is a bit of an art, not a science, but models are accepted, but evaluation is never correct. So what we have to be is reasonable and make sure that particularly the assumptions we make are justifiable in getting to the answers that we get to. So long as we've got those assumptions right, it's normally absolutely fine.
I suppose the other point to make, Tom, is that these test cases do change over time. So what might have been the right answer 30 years ago would have moved
indeed,
on.
And I mentioned case law, and we do keep an eye on case law. Cases do change, and particularly where new regulations, legislation comes in, then obviously those things take a bit of a longer time to go through full test cases, etc., about application of those sorts of things. But the theory of evaluation has remained pretty much the same, irrespective of what the underlying tax legislation is.
Yeah. Okay, thank you.
Mike?
Yes.
If I may, I guess it's just worth highlighting at this point that because of the proposed change in inheritance tax rules, we are expecting greater scrutiny over the valuations applied to things like trading companies or assets used in trading businesses or agricultural businesses where relief is being claimed, because suddenly we've gone from not having any tax payable to them trying to get more revenue from this change. So it's going to be more important than ever to make sure you've got a professional valuation substantiating the position that's being reported to HMRC, and that might be whether it's in lifetime planning if we're transferring things into trust, or it might be on death when we're submitting IHT returns as part of probate.
Yeah, okay, thank you, Joe. And perhaps a final question from Steve. So in practice, how does one record a potential myriad of lifetime gifts? Perhaps again, if I can just ask Joe to cover that stuff.
Yeah, and I think the answer to that is it will depend on the type of gift. So if you're making regular gifts out of income, the level of documentation you need is greater because you've got to prove that you've got surplus income every year. So keeping specific records on your income and outgoings, and we also recommend often that you tell your the recipient of the gift why you're giving it and that it's out of regular income, so there's further supporting evidence of that. In terms of other gifts, I mean, when it comes to you passing away, your executors will be looking back through bank statements, etc., but it's always really helpful to have a record, whether it's a spreadsheet or an email or a letter confirming that gift's been made, so that it makes the executor's position easier when the time comes.
And Gemma, for inheritance tax applications, there's quite a useful form to record your income and the various different outgoings and expenditure to keep a record.
Yes, and from a practical perspective, as somebody who deals with having to help the executors with these submissions to the revenue, make sure you don't password protect it, or you tell someone what the password is, because it's lovely having a spreadsheet, but if no one can access it, then we can't use it. So maybe print one off each year and update it so that it's a flowing 7-year spreadsheet. That would be really helpful.
Yeah.
I think the other thing I'd add to that, Mike, is that often people want lifetime gifts to be taken account of in legacies, so having that record is really, really important as well. I can see Gemma nodding. We're dealing with a client at the moment who wants lifetime gifts to be equalised effectively through their will. So having a record of those gifts is important. Is it all gifts? Is it only over a certain amount and within whatever time period? So keeping those records are really, really helpful for that, as well as the inheritance tax position.
And copy them to your advisors as well, because they can keep them on file as well, can't they? So
absolutely.
So thank you everyone for those insightful answers and discussions. We hope that the case study and presentations have been useful to you and provided you with some areas to consider, as well as some planning options to think about. If you could please just complete our very short feedback survey at the end of the webinar so that we can continue to improve these webinars and events for you. We do truly value and listen to your feedback. And whether you're already a client working with us or not, if anything has come out of today that you'd like to discuss further, please do not hesitate to contact us, as we'd be delighted to hear from you. So that just leaves me to say thank you very much for joining us and enjoy the rest of the afternoon. Thank you all.